Well, good afternoon, Miami. What a nice place to spend a crypto winter. How many of you guys are all spending winter here? Yeah? Well, here's some food for thought. 1977, Miami had actually its first snowfall on record. So I think that we're in a time of record-breaking events taking place. So you never know. You may get some snow this winter. We got a great panel ahead here, guys, talking about risk and markets. We got some market participants here that are really going to help guide us through hedge funds, institutional lending, and macro risks. My name is Anthony Rousseau. I'm with TradeStation, and I'm the head of brokerage solutions, as well as I lead TradeStation Crypto's product strategy. Why don't we go ahead and do some introductions first, guys, and then we'll dive right into the questions. How's that sound? Felix,
Great.
kick us off.
Hey everyone, my name is Felix Hartmann. I am the managing partner of Hartmann Capital. Started one of the first crypto hedge funds about 5 years ago. Been running since it's about risk. We survived. And since then also launched a metaverse VC. And so, it's been a really interesting 5 years to navigate from, the collapses of this year to this is not really news to us. We had all things like FTX in the past, Mt. Gox. We've had the 2020 liquidity crisis during COVID and so forth. So it's going to be an interesting discussion.
Thanks, Felix. My name is Wes Cowan. I'm the managing director at Valkyrie. I run all of the on-chain hedge fund activity. In addition, I'm the lead Web3 analyst for Bentley Global. I do a bunch of work with Volkswagen. And yeah, happy to be here.
Awesome.
My name is Joe Flanagan, so I'm the co-founder of Maple Finance. Maple's an institutional lending protocol, and so we enable lenders to come and access a host of different yield opportunities that are run by a role we call the pool delegate. And so they're responsible for running a lending business on-chain and building out and using all the efficiencies that on-chain lending infrastructure can provide through our platform.
Awesome. Thanks, guys. It's been some unprecedented times, I'd have to say. I've been through several bull-bear cycles here. This cycle has definitely been different with the institutional presence. We've certainly felt that impact in many different ways, in some hugely positive ways on the bull side of the market. On the bear side of the market, there's been some devastations that we're going through right now as we speak. But I think that overall, managing risk in any market has some commonalities throughout it. And I think it's important to think through what are the commonalities of traditional markets risk management that need to either be brought to or highlighted here in the crypto Web3 space so we can evolve and grow and move to the next level of managing risk and being able to evolve this technology and the adoption of this technology. So we're going to dive into some of that talk today. I'd love to get you guys to just discuss a little bit about how each of you guys and your firms have kind of navigated through these challenging times over the past year, and maybe sprinkle on some thoughts on how you guys have managed risk and where you guys kind of see the market going from that perspective as where we're going to evolve to.
Yeah, so picking up on what you said a second ago, how is it different from earlier cycles? I remember in 2018, there was no feeling of safety, which was kind of like a little bit more honest. This cycle around, there was a false notion of safety, right? And so in 2018, I remember when we first launched, there was virtually no options, like options markets weren't really developed. You had just a little bit of shorting on Bitfinex. But this time around, you had options markets, you had really, liquid perp markets, except they were all on opaque foreign, exchanges. And so all the hedge funds were hedged probably in the worst places, meaning like FTX, right? Which is why most of the funds got hit. And so, the evolution that probably needs to happen is that we have more of these tools that actually enable proper risk management, but US-based and properly regulated, where your hedge is not the thing actually blowing you up.
Yeah, that's a great point. Wes?
Thank you. So yeah, we've been lucky enough this year to avoid all of the landmines so far. But I'd say, like the use of technology has definitely been a big part of that. So anytime that we enter, one of the hedge funds I manage is fully on-chain. So we're an institutional structured company, but we manage a fully on-chain hedge fund. And anytime we enter any sort of liquidity pool or liquidity pool-based position, we use various pieces of software to manage and monitor our positions. So one of them is called Nansen. I'm sure, show of hands, how many of you guys know Nansen? Pretty popular. Excellent piece of software for anybody managing a DeFi structured book. And what it allows you to do is monitor each liquidity pool, monitor imbalances, and monitor when smart money or smart money is leaving any specific liquidity pool. So we were in UST all year, looping just like everybody else, yielding 60, 70% on stables. But because we set triggers for all of our pools, 4 days before the Luna collapsed, you started to see in the curve pool, it become very imbalanced very quickly. It started to occur. And even before the imbalance became aggressive, you started to see a lot of smart money leaving. So, through the use of technology, we were able to generate 60, 70% yield all year. Once we saw the curve UST pool become imbalanced and money leaving, we were able to exit without any downside, and we were able to avoid a massive landmine while we were benefiting all year. So again, use of technology, just because everything's so transparent, is so key.
It's so fascinating. The technology has really brought a new level of transparency to risk management from your perspective. Joe, co-founder of Maple, where do you see the risks that lie from a lending perspective? And, considering that a lot of the risks that were prominent in the space had to do with CeFi, but there's definitely some DeFi risk as well. Why don't you bring to light some of those?
Yeah, for sure. So yeah, the main risk that we're managing for hedge funds like Valkyrie and others is credit risk. And so what the platform is trying to push forward, and what it's providing, is a combination of proper traditional credit risk management with bringing all the on-chain transparency and efficiency. And so that is the big difference that exists between our product and many other DeFi protocols versus the CeFi, the risks and what we've seen blow up recently, where you're lending into a black hole, you don't understand where your capital is going. And so that separation between the ability to have not only the transparency of where your capital is being allocated, but it being allocated into smart contracts, where it can't be rehypothecated to other forms or used in ways that aren't intended by that protocol. And so we see, whilst the blow up is painful in the short term for everyone involved, that there can be a real narrative where we push forward to everything moving on chain, because we have that capability, and there shouldn't be this need for centralized actors to be able to use customer funds in ways that they see fit, rather than in the intended way where a customer should really have control of where their funds are being allocated, and the ability to know on a real-time basis where those funds are going.
Right, so in essence, it would kind of reduce the scenario of bank runs and the inability for a customer to get their assets back, right?
Yeah, I mean, it brings in a whole range of things, in terms of withdrawals. There's no ability for me to go into the protocol and just pause withdrawals all of a sudden. And so the thing is that a customer is always knowing what they're opting into, and that the smart contract will behave and act in the way it's intended, no matter what the situation is occurring. Whereas when you've got centralized parties involved, obviously they have the ability to act in their own best interest, and that's what we've really seen recently.
Do you guys feel that centralized risk can be changed through these DeFi protocols? Do you think that we can start to reshape how we have to deal with centralized risk today? And what do you think some of those ways of doing that are?
Yeah, so I think definitely protocols like Maple provide that opportunity. But it's also important to remember that if you want to create credit, you need to do credit work. And so you can't abstract away the need to do credit assessment, to be reviewing financials. And so we think we try and straddle that right balance of where we're bringing real-world credit professionals that have existed in TradeFi, giving them the opportunity to run their lending business on-chain, hyper-efficiency, hyper-transparency, and then that can scale and be a real credit marketplace in the future. So a borrower can come to one place, access all of their credit needs. A lender can come and interact with a whole host of different yield opportunities. And when you have one place where everyone is able to access it in the same way as everyone else, then I think you can start to get real economies of scale and straddle that right balance of transparency with the need for some level of credit work and thesis to be maintained by actors on the platform.
Yeah, I mean, look, from my point of view, where I'm managing hedge funds, I think risk mitigation on the credit end markets, It's a little complicated because we have to make sure we're doing risk mitigation on multiple levels. We use Maple, but I think typically how we look at it is we place everything in buckets, and we're doing risk mitigation based on which token we use. For risk mitigation, we don't go into anything unless it's audited by a certain smart contract company that we're comfortable with. We analyze every single audit that we enter into. We rate every single protocol. We also make sure that we don't over-allocate on any chain, on any bridged asset. So I think it's applying the same risk criteria in the traditional markets. We just have such a unique market with so many unique types of risk out there. And I think that's where a lot of these funds got caught up this year. They were a little too over-allocated on one specific part of the market or one specific chain, or didn't necessarily do in-depth analysis to monitor when contracts were changing or being audited or when GitHubs were changing. So it's just, there's a lot to analyze in the current DeFi markets.
Yeah, I would say infrastructure-wise, like on CeFi, we need a lot more. On both sides, we need more auditing. CeFi side, financial. On DeFi, smart contract. It's funny. We actually just onboarded you guys, TradeStation, and that was the first time somebody asked us for a financial audit. When I onboarded with all our crypto market makers, nobody ever asked for an audit, which is surprising. They just send me a balance sheet. I mean, anybody can make something on Excel. So that needs to be strengthened up. And then on the DeFi side, we always zig and zag where, yes, things went bad with FTX, and so everybody's going DeFi now, but it's also worth remembering there was over $2 billion lost due to bridge hacks this year, the biggest export to North Korea this year. And so that's not the pure solution either. So we do need to improve, the code auditing, smart contract auditing on the DeFi side. During the hedge fund, I was also on the board of Enzyme Finance for 2 years, which is the biggest the biggest DeFi on-chain hedge fund protocol, more or less, where you can set up an on-chain fund. And that is seeing progress. I think there's somewhere at 70 million TBL, which is virtually nothing. I mean, there's tons of funds that have more assets than that whole protocol in itself. But we're definitely seeing a trend where even DAOs are starting to manage funds, fully on-chain. You're running a fund fully on-chain, and the benefit of that is that you have 24/7 transparency. You have much better risk controls where nobody can run off with the money. Sam can't just borrow it and buy some Bahama real estate, right? All these things can be, coded into it, right? Where it's no longer just hoping or once a year check and be an audit, but rather, you really program it in from the get-go.
Right. I mean, even for our LPs, we provide our wallet addresses. So they have full transparency, which in the traditional hedge fund, you have no transparency really on where those funds are being held.
Yeah, so essentially, we still have the counterparty risk. That doesn't really go away. Counterparty risk still exists, but you can better manage your counterparty risk by having more transparency and light into what assets actually are held and actually exist, and then being able to value those assets, right? Do you guys feel like there was a problem with what assets were being used for collateral with some of the blowups that took place?
I think it's because we didn't know. Right? I mean, if any of us knew that this much FTT was being used as collateral, or in other cases, other, small cap illiquid tokens, then we would have never accepted to do business with those counterparties. But because it was opaque, because it was unknown, I think there's too much assumption in the crypto space this year, at least, where we DeFi people and say, oh, 3 Arrows, they're such amazing traders, SBF, FTX, it's a multi-billion-dollar institution. What could go wrong?
Yeah, and I think also having the transparency of the counterparty risk on chain, it changes the dynamic of the way you interact with that counterparty, because they know that their public reputation is on the line, as well as any collateral or things like that. But what we've seen in enforcement scenarios is the combination of having off-chain legal agreements that we can enforce on with that on-chain transparency. If you default on this, it's going to be known by everyone that you've defaulted, and it's going to have broader ramifications for your business moving forward.
Yeah, and I mean, look, I'm sure there's a lot of people in the room that don't like to hear it, but at the end of the day, I do think it's gotten to a point where regulation is needed, right? And if no regulation, at the end, if we don't have regulation, we're not going to have transparency, unfortunately. Human nature is shown to take over, and including greed. And hopefully we don't overregulate, but I think it's gotten to a point where something is needed.
The only problem is there needs to be a middle ground, because what's been happening over the last years is that they just kick players like Coinbase and Kraken, where SEC is literally rejecting to work with Coinbase. And so what do? People move offshore, and then things only get worse. And so I think more dialogue is needed, and doesn't necessarily mean more regulation from the hammer perspective, but just more clarity so that players can know how to act within the framework.
Yeah, and I think Senator Loomis gave us some pretty good insights earlier today, which was great to have her share what they're working on, and they're definitely moving into that direction. And, we all can hope, because I know that working at TradeStation under a regulated entity, it is absolutely challenging to move into the crypto or Web3 space. And it's just, without the clarity, firms that are traditional firms, traditional institutions just struggle to move into this space at any scale at this point in time. So yeah, absolutely, that's hopefully to come. Just kind of going into a little bit more about the future, what do you guys think, talking about institutions, what do you guys think that we need to kind of, I think, improve upon based on this, bear market and kind of the unraveling? I mean, we have the macro headwinds right now, but that's going to change in time. But what do you think we need to do from a crypto Web3 perspective to be able to show the industry and the players that risk can be managed and risk can be transparent for people to understand what they're getting into going forward?
I would almost say just like we need more and better leadership, and also more backstops. We saw this, for example, with the exchange like Binance. But I remember back in 2019, they got hacked. A lot of people freaked out, and then CZ said, funds are Safu, right? Like, we're backstopping it. Nothing is lost. Same thing happened with KuCoin. KuCoin got hacked. KuCoin said, okay, we'll take care of it. Now, whether they're backed or not, I don't know. But at least they said people are being made whole. What I've seen too much with this year, whether it's Celsius, FTX, BlockFi, and so forth, like, we're just socializing losses all across the board, and we're really maximizing how many people are getting damaged by this. And so it's really the job, I think, of every leader, whether you run a fund, whether you run an exchange, and so forth, to find ways to mitigate and limit these losses, meaning decrease the amount of people that are exposed. Because if ultimately after this year, you've got 10 million plus people, maybe 20 million plus people that lost money due to exogenous reasons, that breaks trust. And so, it's funny, because I think with crypto sometimes we go a little bit like full circle. I remember going on Twitter and people said, like, wouldn't it be great if there was something where if an exchange get hacked, all exchanges pay money in, and then we make them whole? Like, yeah, this is FDIC insurance. So some of these things might be good for us. Yeah.
Yeah, I mean, I think also out there, it's right. It kind of feels like the Wild West all the time, and there's so much evolving really quickly. As everything's been unraveling over the last couple months, one thing that I think is really needed in the market, and maybe somebody out here could build it, is really like a Fitch-style company for crypto, where there's like actually a real credit rating system, where you had multiple variables of things that understanding what type of credit risk, what type of issues someone's had in the past. And I think if you had a real credit rating system in this industry that could hold protocols and counterparties long term on what type of decisions and how they've treated their stakeholders, I think it would really help attracting institutional and retail capital to the right places. But unfortunately, we don't have any system for that right now. So when people are entering the market, it's really based on someone's guess, because most people can't read smart contracts, and most people aren't even comfortable reading a real audit, because for anyone here that's read an audit, audits are complicated to read if you don't understand DeFi, real specifics of DeFi. So I think if there was some sort of common language audit system out there, or credit rating system, it would really help our industry advance. So maybe someone here could build it.
Yeah, there are. I think there's a lot more room for improvement there. There's protocols or companies like DeFi Safety that review smart contracts and the reputation of a track record of how you're applying safety to your contract infrastructure. And then there's parties like Credora that are doing on-chain credit, but there's a lot more improvement for the way that those types of tools are used across the space and become more ubiquitous. The only other point I'd add is just more around education. And so it's easy for people outside of crypto to lump everything that's happened all into one pie, where we're all nefarious actors, it's all centralized. And so ensuring that there is that education for the separation between CeFi and centralized parties, and the way that that's just existing in the traditional banking, traditional finance worlds. And this is a real opportunity to change that, and crypto does provide that solution. And so emphasizing that we're not really part of that, the technology that is enabled by crypto is what can provide that improvement to traditional finance and to the problems that we've seen recently.
That's a great point. You guys have all provided some amazing points. Can you guys leave the audience, each of you, with just one point to take away for today?
I know this conversation till now felt very sobering, you know, and very serious. But I think these are these important conversations to be had at this point in time, because they will allow us to, you know, grow stronger out of this, clean out of this, where these kind of things will happen, not anymore, but less and fewer, and maybe in smaller instances. And so I think this is an important like turning point for crypto, where we're definitely becoming a lot more resilient and anti-fragile.
Yeah, I mean, I think people need to do a little bit more due diligence on DeFi. So get comfortable with reading audits, understand what audit counterparties are reputable. I think it's super important, and it's just not done widely enough in the industry.
Well, I think, you know, the bear market is an opportunity to build, which everyone says, but I think, you know, it's important to look back at the last bear market and where DeFi didn't even exist then, right? And so the level of progress that we've made in a very short period of time can't be underestimated. And so with this new bear market, there's a real opportunity. If we make the same level of progress that we did from nothing to where we got to, and we bring more and more things on chain and continue that level of progress through this bear market, you know, I think we should be super excited for what can come in the next few years.
Awesome. Thank you, guys, and thank this panel here for some amazing information. I want to thank Miamiweb3, Kyle, and the entire team for putting this on today. Thank you, everybody.